This is the Collecting Real Estate Podcast. I'm your host, Stephen Purse, here with your co-host, Bill Hamill.
I'm somewhat more comfortable collecting real estate than I am collecting other stuff.
This is the Collecting Real Estate Podcast. I'm your host, Stephen Purse, here as always with your co-host, Bill Hamill. This morning we interviewed Vernon Beckford from DLS Loan. It's really DLS Loan. I think it's DLS Loans, but it should be Loan Solutions because they do a lot more than just offer loan products. Bill, what'd you think?
Yeah, he threw some things out there that I hadn't heard of yet. And it was a lot of that is when someone finds a big deal, a great deal, and they're not able to put that deal together, they solve that problem. They may be able to bring in a key principal to make it happen. Ultimately, that's the goal, is making that deal happen.
Yeah, it's a great way to say it. They do what it takes to help you get across that finish line. And it's because of their understanding of the way these deals are structured, the way these deals work. They have very impressive backgrounds in the financial world, and that shows in what they're doing with this DLS company and the solutions that they offer.
Yeah, there's also a few other little details that I hadn't heard of. So yeah, check this episode out.
Excited this morning to have Vernon Beckford here from DLS, looking for some insight on mortgage loan origination, as well as hearing more about his own journey collecting real estate. Vernon, let's get right into it. Tell us how you got into the real estate industry.
Sure. And thank you for having me, gentlemen. So my foray into real estate was not deliberate. I was an undergraduate student at Columbia University and was thinking about pursuing a career in investment banking and joined the investment bank Credit Suisse. And at the time, we had the opportunity to do rotations. You could go on the investment banking side, you can go sales and trading. I had the opportunity to sit on a real estate desk, which at the time was the fixed income structured finance desk, where we were securitizing mortgage loans. And I quickly learned that what that actually meant, because I'd never heard of it, and realized, well, wait, you're actually involved in real estate investing. And it instantly took hold, and I loved it. And I knew then that if I was going to be in finance, I wanted to do it through the lens of commercial real estate. And I was at the time a political science major and had always thought of real estate as a way to actually effectuate really impactful change in community development, economic development. So it was just a marriage of all those worlds. And I've been in the industry ever since.
Excellent. It's great having you today, Vernon. Getting into finance, which you're an expert at, and I correlate that with real estate sales. I was explaining that to someone at our meetup last night, is you can make a living selling real estate, but you build wealth owning real estate. I know you had mentioned that you own some properties. What was that transition from the finance world into jumping into your own real estate collection?
Well, I got to tell you, so it's a great question. So when I started in finance, I had this kind of vision, this idea that, you'd have to work for X amount of years, and then eventually maybe you buy something and you rinse and repeat. And my business partner, Eric, actually proved that was wrong almost immediately after we graduated college when he joined Goldman Sachs. But on the side of working full-time at Goldman Sachs, he was going and buying duplexes and triplexes in Jersey City. And I was saying, well, how the heck is this guy doing this when he's got a full-time job? And then eventually he quit his job and started building that full-time. And I was watching from kind of the institutional castle saying, I need to get into this in some capacity. Like, it's fun to work on the mega deals, but it's really fun to have your own project. So what I started doing was investing passively in other people's deals. That was an easy way for me to learn on the job while I was learning in my other job, and also manage my time. And gradually, my involvement in those deals evolved and increased. And so what started as a small investment in someone's property evolved into me making loans to folks, making hard money loans, evolved into me syndicating with other folks to buy properties. And gradually, that became really kind of a nice little parallel to my corporate life. So that when I decided to leave corporate, I said, okay, I've had a grounding both being a deployer of capital on the big institutional side, but I've also worked on small deals and gotten my hands dirty on that front. So that was really the inception of DLS when we said it's really hard sometimes to be a small real estate investor and buy things and get them financed and put capital together. And you don't have the resources, you don't have the transparency that the big boys get. And you got to be scrappy. And that's why a lot of people try it and they don't get very far because it can be kind of tough, lonely, and discouraging. So how can we bring resources to folks to get their deals funded that are early in the first kind of set of they've rounded first base in their career of investing, but they can get much bigger if they just kind of have the tools and the resources and the infrastructure to keep building.
I can definitely relate as a finance major who thought I had to spend an entire career working for a big financial company, hearing about real estate and seeing that as the golden light, the fork in the road as an alternative path. I didn't go to Columbia, but definitely feel what you're saying there. I want to hear more about DLS and the products that you offer, but hearing you mention being involved in some syndications, that's what Bill and I mostly focus on these days. Tell us more about your projects that are syndicated.
Yeah, so we were blessed, I would say, to meet a really phenomenal operator in Texas, who's really, I would say, a rock star in the making. They probably have 1,000 doors under management now, and we're working on a new project with them that would effectively be another 500 doors. Um, Value add strategy, class, I would say C, B minus, turning that into class B plus. I would say solid workforce housing in markets that, frankly, have not been on the same tear as some of the darling markets, but have proximity to those markets and some of the same strong endowments. So in this case, the steel is just outside of Houston Metro, and just a lot of good endowments to the local area as to the economy and the economic base, even in spite of all the noise we're hearing about recession. So we really like deals like that. Also in process on a transaction a little bit closer to our backyard, which is in Brooklyn, New York, with an asset that I think, obviously, New York City can be a really scary place for some folks to invest with rent control laws, rent stabilization laws. But this is a really interesting opportunity because the sponsor has converted some portion of the units to market rate, hasn't really moved rents up as much as they could. There are other rent stabilized units that there's some opportunities to actually do some things. So that's another interesting play that, if you understand the nuances of the locality, can be really interesting because you may see value in areas that other folks just wouldn't look or wouldn't have the confidence that they could monetize.
Very interesting. Stephen and I are in the Albany, New York market. We're active here. I've been active here for a long time. So the deal flow comes based on, just being around for a while. And we also love that Pinellas County, Tampa area of Florida. And what we've witnessed over the last couple of years, the real estate investor world, when you say New York, they put up the X and say, no, it's completely a disqualifier. So
Absolutely.
we are in Southern market and that New York market, and you just explained the same, which we don't see very often. Texas is super hot. A lot of investors want to be down there, but you're also looking at a project in Brooklyn, New York. And with you being that commercial lender, tell us, is there any difference on that perspective from the lender who's lending on that Texas project in relation to the Brooklyn project?
Yeah, that's a great question. So, in my experience, New York is a very interesting market. I think from the lender perspective, many people will take the same perspective of those as individuals that you mentioned, which is to say, we're not even going to look at it. Why? Because they think they can't be competitive in pricing the deal because there are some folks that are active in New York that are just going to provide loan terms much better than them. And so they kind of volunteer themselves out of the opportunity. Alternatively, though, there are those that live and breathe the market, where they will happily look at it if you know who they are. So there's a deep bifurcation of the two categories, but it's very similar as the investment world, because as we know, New York City is a dog eat dog, probably the most competitive market in the country, and so understandably, some folks just say, I'm gonna bow out of that fight before I even waste my time, and that sometimes leads to lost opportunities.
So sticking on that topic of where is your interest in lending? What is your appetite as a lender? Bill started his career in the city of Albany, and after that long career, he now focuses on the suburbs surrounding Albany, and has lost a lot of interest in that inner city investing. As a lender, do you have any? Is there a difference between investing or lending inside of a city or in the suburbs, whether it be New York or another state?
So I remember when I was first involved in Wall Street, there was this whole debate as to city versus suburb, right? At that time, it was all the energy was in the urban core, infill destinations. Question was, will people actually move out to the suburbs like they have in prior generations? It looks like everything's in the heart of the city. Obviously, well, now and COVID accelerated that. We've seen that trend that has not proven to bear out. Yes, people love the cities, they've lived in the cities, but there's been a ton of activity in these bordering suburbs that are, proximate to major urban centers but not in the heart. And that's where you, in my mind, you could find some real relative value both in multifamily and other asset classes, because it still drafts off the benefits without having quite the same amount of competition. And so I love that idea that Bill asserts, because I don't think it's mutually exclusive, but I do think that folks in this market especially have had to pivot because they simply wouldn't transact if they just were staying in the urban core, because pricing was just, frankly, hard to justify. So if you find the right spots, the right pockets in a good suburb, I think they could be a great destination for multifamily investing. There's no question about it.
No, and I agree. I've seen this with cities over time where they'll get an appetite saying, okay, we need to do something to revitalize our city. So they'll offer incentives and get investors to come over. Stephen, you've seen that in Schenectady. Schenectady, is a city nearby us. And then they did a great revitalization to bring back their downtown. My thought process was, absolutely, absolutely. And my thought was, the cities in relation to our outside towns, they play by a different set of rules. It's not necessarily, well, I've seen differences in the quality of the city of Albany, which is unfortunate, but also it's so much easier to do business in those towns outside the cities, where the city of Albany, for example, and a few others have really clamped down regulatory with code and just being so in your business. Believe me, I when I was a manager and an owner, we have a check sheet. When people are moving into our units, we make sure that people are moving into a clean, safe apartment. So it doesn't matter if it's in the city or outside the city, that's how we do business. But the cities have made these rules so difficult and so tedious. The lenders look at that because, hey, there are partners in these deals, and a lot of this regulation is certainly comes down to another line item in that underwriting.
It's an interesting perspective and an interesting question. From my point of view, lenders focus, geographically at least, are really driven by two things. It's one, driven by the fundamentals of that market, and two, it's driven by sponsor interest. So I, as a lender, can use it as a proxy that if you, Bill, and your cohorts are choosing not to go into a certain market, there's a reason why, and that it may then in turn suffer from underinvestment, which will then make it less interesting for me. So it's almost like a circular reference in a sense, because a lender is not going places very deliberately unless they have a good reason to, unless sponsors want to go there. So if sponsors don't want to go there because the local municipality makes it hard to be there, then those are the places that won't get investment, and it'll just compound itself.
All right, I'm really impressed by all your answers so far. As a lender, I know you all have very trustworthy crystal balls. I want to see what yours is saying about the market moving forward. If you can look into it and tell me what your expectations are.
That's the question of the hour, isn't it?
Always
So
is.
I think, I think there's going to be bumpy road ahead, but I think the extent of it. So this is what I think. I think there are many operators that are currently were buying value add multi over the last 2 years, and they bought at top of the market, and it's going to be very difficult for them as their business plan is now coming to fruition to refinance their loans. And that's just the reality of it. They won't necessarily have hit their numbers, or maybe they did, but even if they did, they're going to have a difficult time rationalizing the cash out refi that they were anticipating. That means A, they're going to either have to sell their property and make less money than they ultimately wanted to and return less capital to their investors, which isn't great. Or B, they're going to have to seek what I would call gap financing, rescue equity, rescue debt, whether that's preferred equity or mezzanine debt, to plug holes in the capital structure, to keep themselves alive, to fight another day, to buy some time. So I see that being a real opportunity for folks with dry powder in the market. I see that as a point of pain for some operators that that are going to find themselves in that position. Bill's been in this business for a long time, so I think there are a lot of folks that got into multifamily over the last couple of years. They haven't had to really go through a down cycle. They didn't experience the Great Recession, and it's going to be a real test as to who kind of separating the wheat from the chaff in terms of who's a real operator and who were guys that were good at raising money but don't necessarily know how to manage assets. So I think all of that's going to come to light. I think it's going to create some interesting buy opportunities. I think rates, unfortunately, in the short term will continue to go up. I think the pace of the increase will decrease, but I don't think that rates are coming down in the near term. And I think that lenders are going to be very, very conservative as to what they put money in because they have no confidence as to what the world's going to look like in the near term. Unlike the multifamily operator who gets paid for taking upside risk, the lender has only downside risk. So you have to ask yourself, if I was in the shoes of a lender where I don't get to make a 2x, I just get to make my coupon and walk away, is now the time where I want to lean in and bet on this operator and do an 80% loan when I can't tell you what exit caps are going to be? I can't tell you what the normalized interest rate will be. If somebody wanted to go buy an interest rate cap or a swap, it's just going to be so damn expensive. It doesn't make any sense. What incentive do I have at this point in time to put my money out? And unfortunately, on a lot of the deals that lenders are seeing now, they don't get a good answer to that question, and so they don't lend, which means that there's just less volume of transactions happening. So I think that's all to say. There's going to be bumpiness. I hope that sellers are a little bit more realistic in terms of their pricing and you start to see a little bit of the loosening on the sale prices. I personally was looking at properties and you'd see rates going through the roof and sellers not adjusting their pricing. And you say, listen, I get it. It's never fun to have to adjust to the new reality that your property that you thought was worth $1 million isn't worth $1 million today anymore. But you're going to have to see some of that actually feed its way through the markets for there to be anything that resembles a more normal functioning. The last thing I'd say is that if you look at REIT stocks, REITs are a good reflection as to what the market thinks about the state of real estate. And REIT stocks, I think last I checked, were down north of 30%, But if you look at private assets, they were down recently, 13, 14%, right? So what that tells you is that either the public markets are overreacting or the private markets aren't adjusting fast enough, which is, more likely the case. So I think they're going to be good buying opportunities, but it's going to be a challenging environment. And, we'll see who this is where, the strength of metal gets tested in times like these.
Yeah, a couple things there. And that last recession, it seemed like there wasn't any lending going on in 2009, 2010. I'm sure there was because One is it fair to say, lenders have to lend? That's how they make money in any time. I'm sure that there was lending going on in 2009, 2010, because, you got to keep that ball rolling. And then going into what you said as far as the Brooklyn to Texas market, it comes down to the relationship with your lender, whether they're going to want to lend in either market. You can make money in
Correct.
any market, whether it's New York
Absolutely.
or Texas. And it all comes down to relationships once again, Stephen, and the credibility of that borrower, which leads me to what you were just saying. I'd like to be a fly on the wall when you guys are underwriting a loan, the experience of that operator, where a year ago, were you selective? Was it even a conversation on the experience of that operator, where now is it much more of a focal point?
Great question. So when I think about how DLS is oriented, because we're so focused on small to mid-size operators, we've always by necessity been really, really, really focused on the quality of the sponsorship, because you want to pick the right horse to bet on, for lack of a better term, and the risk is much higher for folks that are either doing um, smaller transactions, because they typically may be more mom and pop, or they may not be as experienced. So it's always been a major focus for us. It's doubly so now because, for obvious reasons, we're in an economy or an environment where you can't take it for granted that the market will just save you. That being said, I think the way that we've often mitigated the fact that someone may be a mom and pop or they may not be as experienced is showing that they have complete mastery of their own business plan. Meaning, not that things won't go wrong or that um, the deal won't, have issues that come up that are unexpected, but do they have a robust plan? Do they have a robust thought process? Have they created guardrails on how they're going to execute and what happens if the plan doesn't um, conform exactly to their expectations? And if we can really make a strong case that there's a high conviction that they know what they're doing and that they've thought through the risks, it's a lot easier to get comfortable with any deal. And I would say that's regardless of any market, but in this market as well. Deals are still happening. Deals will continue to happen. Um, it's just the threshold for proving that case is higher, and some folks are not going to meet it. And so for us, I think one of the biggest advantages for us on the advisory side, when we advise clients on how to obtain financing, if we're not going to fund it ourselves, it's really how to paint that narrative and how to address those objections that we know they're going to face in advance, as opposed to being reactive and then leaving someone with the impression that you really haven't thought through your deal.
So if you focus mostly on these small, medium-sized operators, some mom and pop operators, what does that ideal transaction look like for DLS?
Sure, thanks for asking. So DLS is what I would call a hybrid model. So we do have a balance sheet where we can lend directly, but we're also an advisor where we will arrange financing on the deals that we don't fund. So what do we fund directly? We fund residential investment and small balance multifamily. So residential investment being fix and flip, short-term rental, single family rental, and small multifamily. Once you get out of that and exceed, let's call it $3 million in purchase price, or rather $3 million in debt, rather, we will act as an intermediary to raise capital, debt capital on your behalf. And that can be through a host of sources, whether it be banks, debt funds, life insurance companies, the like. Now, what we realized very quickly when we started the company, and I'm sure you both can relate to this, is that while helping someone grow by getting them access to debt is a very attractive, every sponsor has an equity need somewhere along the line that in many cases is more pressing than their debt need. So what we started to do is do things like fund earnest money deposit loans, so that sponsors were going out and they're making multiple offers. If ultimately they get two or three that hit and they have to put up a big check, they have the resources to do that while they're going out and raise. So we started doing that. we started bringing key principles to the table because, as you both know, if you go out and even if you get a non-recourse loan, they're going to be called what are non-recourse loan carve-outs, where if certain things happen, the loan triggers to full recourse. And so usually the individual that stands under that guarantee needs a certain net worth liquidity. So we started bringing those key principles to the table for operators so they could meet that threshold. Then folks said, listen, we're syndicating and we need to close by X, but we're not going to close our raise. Can you provide us equity capital to close the raise and give us time to backfill it? So we started providing rescue equity in that respect. And then for folks that were big enough, who we thought really had the potential to scale, we said, listen, let's introduce you to institutional private equity companies that can provide you more programmatic capital to diversify against just the pure retail model of going through syndication. So really, when I look at our offering, to just say that we're a lender is actually a little misleading because I'd really say we're a comprehensive capital markets advisor. And wherever you're trying to fill the hole in terms of how you grow, we try to find and optimize the best capital stack to help you get there.
Wow, that's awesome. I saw some matchmaking going on there, Stephen, where, he's able to, you got a great deal and if someone's struggling to put the pieces in place, you're able to put KPs that may make sense on that deal. That's fantastic.
Going back to networking again, right?
Absolutely.
And I also found interesting financing the earnest money. I haven't heard that. Has that been something you have done with your firm since the beginning, or is this an evolution?
That was an evolution. I wish I could say that we thought it up out of nowhere. It literally was a case where we had a client we liked, we'd done business with. They were under a time crunch. They had to write a fairly substantial EMD. We said, listen, we'll fund it because we know that you'll get your deal done, and we'll structure it like a loan. And we figured it out. And so ever since then, we realized there's a product there because we don't see other people really doing it and focusing on it. And we don't do it because it's a profit center for the company. We do it to build a bridge for our clients in order to be able to get them into the deal so that we can actually provide either the debt placement services or help in some other way. But it's been a nice lifeline for folks, especially as they start getting into bigger deals and have to put up bigger deposits.
Yeah, I'm really impressed by that variety of different solutions that your company offers. Is 3 million a hard cutoff, or is that a little bit of a moving target?
Not a hard cutoff. We do have the ability to go larger. I would say once it gets larger than 5, that's probably where it starts to get a little bit of a hard cutoff. But the good thing is that what we never do, I've never said in our hybrid model, if we think that there are sources of capital that are more affordable than what we can provide, then I would much prefer to be transparent with you and let you know that and give you the option and give you 2 options. So all it amounts to for the borrower is more choices at the end of the day.
Let's talk about the potential of the bridge financing or that construction rehab. Do you guys offer that? I know the value add deals we all love. We only do deals if it has that upside potential, especially going into this cycle when you're doing a great value add deal with that upside on rent growth or operating efficiencies. It insulates going into some uncertainty. How do you feel about bridge financing, construction rehab type financing?
And bridge has really been the lifeblood of our business over the last couple of years, and to a lesser extent, new construction. We don't fund new construction directly, but we've arranged financing on that front for several clients. Bridge is, I would say the average deal we do is a bridge deal. So I love the business model. I think it's obviously made several operators a good amount of change over the last couple of years. I think it's I dare say a saturated space. So there's a lot of people doing it. And I think there's a perception that I can just buy any Class C property, whip up a coat of paint and, swap out the cabinets and suddenly it's a Class B property. And I think people are learning that that's not necessarily the case, especially when you're going into tertiary markets and expecting to see a 30% pop in rents overnight just because, so I
You got to give
think
it a
you have
trendy
to,
name too, like the Huxton or
yeah,
that's the
exactly.
key,
Yeah,
right?
that you know what? That's right. Throw some signage up there, give it
Yeah.
a fancy name, and of course, they're going to come and pay 30% more overnight. So
Yeah, but I don't care what the sign is. We all know location, location, location. You can take that C property, throw a sign, do whatever improvements you want in there. But if there's people that aren't going to be renting in that location, what do you got?
exactly. So I would say if there's some degree of exhaustion, it's around folks that just think that you can sprinkle a little bit of magic and call any multifamily deal a value add deal, no matter what it is. There is skill involved in the craft. The market matters a lot. The location matters a lot, and you really need to understand the demographic for that submarket. And so, if any mistake I see happen all the time is somebody, let's say in New York, like myself, who'll go to a tertiary market, look at rents that seem so affordable relative to New York that they have to be able to push them, and then just assume that they're going to be able to just go there, put very minor capex, and make a ton of money. Maybe they could have if they did that 4 years ago. Now it's a lot harder just to draft on that trade, obviously, especially where rates are.
Well, once again, it comes down to that operator and being familiar, with that market. And, professional operators are going to do their homework and make sure that they're familiar with that market so they know what they're investing is. It sounds real simple, but that's basically what we just discussed there. And I think that's what a lot of people have been doing in a hot market. I think you're able to get away with it to a big degree. But the bridge financing right now is attractive to me for the right deal. But as you discussed earlier, people who got into a bridge, say, a year or 2 years ago, and they underwrote refinancing out of that or going into that long-term financing at a particular interest rate, may have a bit of a surprise.
Absolutely. Absolutely. And if you look at the bridge market now, the issue for a lot of folks is if you're leaning very heavily on a syndication model where you're assuming I can get 80 or 75% leverage, well, now a lot of the multifamily bridge lenders are only going up to 65, and in many cases, 50 to 55% loan to cost. That leaves a real hole when it comes to raising equity. And so now folks are saying to themselves, wow, not only are my returns compressed because my cost of capital is higher, but I also have to raise a lot more equity. I can't offer the same returns. It's a very challenging environment. And so if there's one good thing about that is it kind of shakes the leaves, because the folks that were kind of on the margins, and just doing this as a trade rather than an operating business will naturally kind of get washed away.
Excellent discussion. I really appreciate having you on today. Vernon, this is the Collecting Real Estate podcast. So they say you have to have 3 of something to make a collection. So we're going to wrap this up with 3 questions for you. Number 1 is, in 5 words or less, what is the most important thing you've learned since you started collecting real estate?
Be patient, be consistent.
Excellent. Number 2, getting outside of business a bit here. What are your 1 to 2 year personal goals?
1 to 2 year personal goal would be to potentially relocate. I have a 3-year-old daughter. My wife and I are looking for more space. The little one is all over the place. So trying to figure out where that is and finding a place that we think she'll love.
Uh-oh, another person's leaving New York. Where are you going? Where are you going?
It's still a toss up. It's still a toss up. My parents are here, so that leans in the state's favor. But we may be taking our talents to the DMV area, the DC Metro, but no commitments yet.
Gotcha. Yeah, I've been in New York my entire life too. Fortunately for New York, a lot of people, we have roots here, and no matter how difficult they're making it on us, I don't see myself going anywhere, at least for a large portion of the year. Last question for you. How can we and the listeners assist you? How do we contact you?
Yes, absolutely. So please visit dlsloans.com for more information on DLS. Check me out on LinkedIn. I'm there all the time. If you want to ask a question about a deal, I'd love to make myself available to you. You can DM me. It's Vernon Beckford. And if you want to email me, it's vernon.beckford@dlsloans.com. One word, dlsloans.com.
Excellent. Appreciate you having on once again, Vernon. Enjoy the holiday.
Likewise.
And we'll stay in touch.
Thank you so much. Great speaking to you both.
Thanks, Brian.